Good afternoon, everybody. Thank you for joining us today for the fourth in our TAMIM webinar series. Today, we have the pleasure of the company of Ron Shamgar, who is the head of our Australian equity strategies at TAMIM, as well as the Chief Investment Officer at TVG Capital. We look forward to listening to what he has to say. Before I head into today's webinar, we'll need to run through just the customary disclaimer slide. And for those of you who've heard this before, you'll obviously be aware today is not about specific advice. We certainly are not aware of the personal circumstances of everybody who's on today's webinar. So please take everything we have to say today as general in nature and obviously not specific to your personal circumstances. Today, you'll be hearing from myself. For those of you who don't know me, I am Darren Katz, and I'm the Managing Director and Founder of TAMIM Asset Management, as well as Head of Investments within the firm. Joining me, as I said earlier, is Ron Shamgar, who's the Head of Australian Equity Strategies and the CIO of TVG Capital. Ron manages two portfolios within the TAMIM group. He manages the Australia All Cap portfolio as well as the Small Cap Income portfolio. Before I hand across to him today, I think it's important to just point out that prior to joining us at TAMIM, Ron had successfully managed and founded the Code Fund investment group, where he was able to annualize around about a 16% return through the 5 years that he managed those portfolios. Please, can you take some time today, if you'd like to ask any questions? You'll notice on your toolbars on the screen there is a Q&A button. If you could take some time to just type out the questions that you'd like to have covered off at the end of the actual formal presentation, that would be most appreciated. We'll take some time to answer all the questions, and the questions we're not able to get to, we'll put some written answers to across the response to you. We'll also be sending out a recording for you of after today's webinar, and that'll also include the slide deck for the webinar series as well. So with that, I might hand across to Ron to give you his presentation today. Thank you, Ron.
Thanks, Darren, and good afternoon to everyone. Thank you for attending today's webinar. We'll start today by just talking about sort of the investment philosophy of the TAMIM All Cap Fund, which I manage. You know, the investment approach that we use is a value-oriented approach. So we're looking for companies that meet a fundamental-based investment process. So generally profitable, growing businesses. And we're looking for businesses that are undervalued, but you know, cheap or undervalued doesn't necessarily mean a low multiple or a cheap stock. It could look expensive now, but if a business is growing really fast, then it's actually quite undervalued on a 2-year outlook. And we look to generate long-term capital growth by buying these companies with momentum that are growing earnings, generating cash. And we're looking for industry with tailwind, so trying to avoid industries that are structurally challenged. So just quickly about myself. Prior to joining TAMIM almost 2 years ago, I founded and I managed the TBF Small Cap Value Growth Fund for close to 5 years. I've been investing personally and managing other people's money for the last 17 years. And during my time at TBF, we did 16% annualized net return that per annum. I've joined TAMIM 1st of January 2019. I took over the all cap portfolios, repositioned them, and during the calendar year 2019, the portfolio did really well, close to 56% net return. And then we also launched a new fund, the Small Cap Income Fund, which did close to 39% last year. And we'll talk about some of the returns during this calendar year and what's been happening. So if we take a look at, you know, Aussie equities and sort of take a look back at what happened in 2020, obviously this has been an extraordinary year. If we go back to the beginning of the year, the year started really well, and as we all know, COVID emerged. And what was quite interesting is that during the March sell-off, essentially the markets started selling off in late February. And this is actually an interesting time because at February, this is when companies are reporting their results. And in fact, the majority of the companies in our portfolios were reporting really, really good numbers. And it was almost, there was a disconnect between what the market was telling us was going to happen, which ended up being right, and the reality of the companies and the management teams that we were talking to, during late Feb and into the March roadshow season. The management teams were yet to see any impact on their businesses, yet the markets were selling off aggressively on a day-to-day basis. Obviously, the markets were right, and we got caught off guard to some extent. We could never really see the world shutting down, countries locking themselves down, so essentially there was the fiercest and quickest 40% sell-off pretty much in the last 100 years. So how do we react? Essentially at first, it was unclear exactly, which industries and which companies were actually going to be impacted. So what we did was, it was really good at the time, we basically spoke to management teams of many companies on a regular basis, just trying to understand which industries are going to be impacted, which companies are actually going to do well. And, it was probably sort of towards April that we started to get a sense of the COVID winners. Essentially, industries that are going to benefit from people staying at home, which are obviously, online retailers, online lotteries, meal subscription kits where people staying at home, cooking at home, payments companies, nobody wanted to touch cash, obviously, payment terminal companies, and so on. And even, funnily enough, consumer finance companies were actually doing okay with the government stimulus, the JobKeeper payments, the early access to super and so on. Consumers were quite cashed up. Everyone had, debt and rental deferrals. And so people were actually paying down debt quite easily, and consumer finance companies were doing quite well. Buy now, pay later were obviously benefiting from the shift to online shopping. And so we really pivoted the portfolio quite quickly in early April as we started to realize which companies are going to be the COVID winners. Also, the telco businesses, the consumption of data, working from home, staying from home, companies with remote working staff in different locations drove huge demand to that sector. And we obviously pivoted to some of those companies, which we'll talk about later on in the presentation. So we kept regular contact with the management teams, and since then we dramatically have outperformed the market since March. Just to give you an idea, the TAMIM all cap fund for the calendar year, we've turned positive, about 5-6% up. The market is probably down around 7% still. In July alone, we did 11.34%, and August, which is an unaudited estimate, we're up about 14%. So, we've outperformed by managing to, instead of just sitting there like a deer staring at the headlights, we've actually, taken action and pivoted the portfolio. So what have we actually learned from that correction? Probably two things. The first one is, we've implemented a new policy, which Darren will explain in more detail towards the end of the presentation, but essentially a downside protection overlay for the portfolio. And essentially the sort of market put options, which if there is another heavy sell-off on the market, it will cushion some of that down side and will give us some protection so we can keep managing the portfolio the way we want to. And the other thing we learned, which is obviously easier said than done in hindsight, but it's almost in a way the markets, by selling so aggressively back then, they were trying to tell us something. And when that happens, sometimes you do need to listen. Maybe in hindsight, we should have gone a lot quicker into more cash. But what matters is what we've done and the results, which are extremely pleasing. So if we look more ahead now into the rest of this year and next year, why are we still positive on equities? Well, essentially investors, are searching for returns. The world has gone into a huge amount of liquidity and money printing and fiscal and monetary policies, stimulus, and interest rates are close to zero. They're probably going to stay at zero for quite a few years. and investors are searching for returns. You know, there's a lot of talk about this new younger generation of investors, the so-called Robinhood investors who have come into the market. But you know, these are hardworking young people who have made a lot of money, they've saved, and they actually can't get a return. They cannot get a return on their investments, and they're looking for somewhere where they can get a return. They're not going to get it in a term deposit. You know, they're not going to really get it in the property market. Equity market is essentially the best place, and we're going to see it consistently outperform. You know, we think property is probably going to be okay, but it's still going to be constrained, tighter lending conditions, you know, with border closures, lack of immigration. We just don't see property performing as well. As I mentioned before, essentially you're getting nothing on your cash in the term deposit. And so we're quite bullish on equities longer term, although we think it's going to be more of a stock pickers market rather than just buying an index. You know, in terms of the economy, obviously there's been a lot of concern what happens when these government measures sort of end, you know, the JobKeeper and so on. Obviously that's been extended from September. It's, you know, I think the government is sort of going to taper off this stimulus slowly. That's going to go on now till March. But at the end of the day, you know, this economic downturn is essentially as a direct result of government response to this pandemic. And because governments have essentially created this crisis in the way they responded, they're not going to let this, you know, fall off a cliff, so to speak. And so we think governments will continue to stimulate. I think the stimulus will sort of change over time from just, you know, plain sort of JobKeeper paying people's salary to maybe more infrastructure spending, tax cuts, and so on. But we think that will continue. You know, we think that the central banks around the world will continue, you know, printing as much money as needed to support governments, stimulus measures. And I think eventually, you know, if you look at COVID, you know, I think eventually there will be vaccines, there will be better treatments. And, you know, maybe in a year or two from now, people will just move on. They're not going to be as concerned about it. Borders will open up, life will turn back to normal, and you know, life just keeps going on. Now, in saying all of this, you know, we have had a good run this year in terms of the markets, and I think it's only healthy if there's going to be a little bit of volatility and a pullback. You know, I think any volatility is an opportunity to continue to buy in these companies that are actually benefiting from this essentially structural change that COVID has brought, a digital transformation to the way people shop, pay, and consume data, or the way they work. So we think that investing in these right industries will continue to be well, and any volatility that we expect going into, you know, the US elections or whatever it is, will be an opportunity to buy into these companies. So just briefly into our investment style. I'm not going to go into each one of these, but essentially we're looking for companies where we have revenue visibility, you know, companies that have recurring contracted revenue. This is what we're looking for. So we're trying to avoid companies that are reliant on short-term contracts. So, you know, telcos, software, payments companies, these tend to have a very recurring element to the way they generate revenue from their customers. We're trying to understand, when we're looking at a company, we're trying to understand what's actually going to drive revenue, what's driving profits. We're trying to understand whether this is a company that's in an industry with tailwinds, or is it a structurally challenged industry, and trying to avoid this value trap. Sometimes companies look really cheap, but they're just in a long-term decline due to their industry being disrupted. So we're actually trying to buy the disruptors rather than the ones that are being disrupted. Ideally, we're looking for profitable companies that are generating good cash and generating free cash generation with, you know, little capex. Although we don't mind buying companies that are growing really fast, scalable businesses that are growing the top line. And if the opportunity is quite big, we don't mind them running losses in order to grow that top line quicker. And so we think that that's okay as long as the business is really scalable and that momentum is accelerating in that growth. We're looking for businesses with a good balance sheet. So ideally, net cash, or even if they have debt, as long as it's manageable in terms of the interest cover. And I think the key, especially with our focus on that sort of small to mid-cap part of the market, management teams are really important. We're looking for guys, we're looking for management teams that are essentially got a really good track record and are aligned to shareholder interests. So, a good skin in the game, management teams that have done this in the past with other businesses, founders that understand their industry. And then, when we find all these things, we're looking to what's going to make other investors buy this company, what's going to drive the share price higher. So we're looking to understand what are the catalysts to re-rate the share price. So sometimes you find a business, it looks cheap, there's no clear catalyst to get other investors to buy it. It can end up underperforming for you for a very long time. And then finally, when we tick most of these boxes, we're looking to buy at a discount to intrinsic value. Now we try and value a business, whether it's DCF, whether it's a multiple based on its comparable peers in its industry. We're trying to sort of figure out what is the business going to make in the next 2 to 3 years, value it, and then buy it at a big discount. But, we always say that we rather be approximately right than precisely wrong, meaning that whether a business is worth $1 or $1.20, it doesn't really matter as long as we're buying it at 50 or 60 cents. So that's really the key here. And then if we look when to sell, essentially, selling is probably the hardest part of investing, in my view. I think that it's quite easy to buy a company. Management teams, they tend to be always biased and bullish about the prospects for their business. And so, you always buy a company because you can always see that upside. But, when do you sell? So we try and take out the emotions from selling. And over the years, we sort of developed a system for that. So essentially, we're looking at, has the fundamentals changed since we first bought the business? Has something deteriorated? Have they taken on too much debt from acquisitions? Have they lost a major customer or so on? And so that could be a reason to exit. If the share price exceeds our valuation, so if the share price has gone above our valuation and everyone is excited about the stock, it's probably time to take profit. We might not exit the business if we really like the prospect of that company for the next few years, but we will take profits and look either to buy back in if it drops back lower, or exit it completely if the share price continue to exceed our valuation materially. And then, obviously we are managing a portfolio. We don't want to own 100 stocks. Ideally we own 30 to maybe 40 stocks in a portfolio. And so if there are better opportunities with larger upside elsewhere, we may decide to switch a position where we don't see as much upside to a better one. And finally, this is more of this is a rule where we kind of developed like a sixth sense over the years. Essentially, when a company does really well and everyone's excited about it and the share price is going much higher and all the brokers are promoting it and putting a buy price target on it, and it's probably the utmost point of optimism. It's almost like the ducks are quacking and it's time to feed them. And so this is something where sort of over the years, when it feels like the sector is really bullish and the ducks are quacking, it's time to sell and take profits. And arguably there is a few sectors in the market that are probably quacking at the moment. And so we'll now talk about some of the companies in the portfolio, which is probably the more interesting part of the webinar. So essentially, EML Payments. So that's a company that we've owned for the last almost 2 years since I've joined. It's a really, really good business, a global payments platform. They are a MasterCard and Visa issuer, and they're essentially a global business. They enable companies to run programs for their customers to access their funds, whether it's physical debit cards, whether it's mobile digital cards, whether it's a virtual card. They work with governments in Europe for government disbursement funding. They enable fintechs, digital banks, and so on. to allow their customers to have a mobile wallet and access their funds. They run virtual cards in the US, and for the buy now, pay later sector, where they enable a virtual card to be instantly issued and enable a transaction or a purchase. In Australia, they do the salary packaging for all the major players here, and they have a global gaming solution where punters can access their winning instantaneously. They are also the largest gift card issuer for shopping malls globally, and obviously that has been a headwind for them this year with COVID and the shutdown of malls. But essentially, that with the acquisition of PFS, Prepaid Financial Services, earlier this year, the gift card side of their business is now not as big as it used to be. And over time, although we think that will recover as the world sort of gets back to normal, we think that their non-gift card part of the business, the reloadable, the more sort of high growth part, that will continue to grow and be the majority of the business. If you look at the top right, the bottom right of the slide, this is a company that has an amazing 6-year track record, essentially starting with one customer, one program in 2015, and growing to $14 billion of gross debit volume last financial year, really profitable. Unlike many of these fintech businesses that are listed, they're actually growing the business profitably year on year. 90% of the revenue is recurring and contracted for at least 5-6 years. And we think COVID-19, obviously, except for that shopping mall gift card business, which has been a headwind, we think the rest of the business, COVID has been a real sort of tailwind for them. The acceleration of digital online payments, whether it's buy now, pay later, whether it's digital banks, the need for this, for EML's solutions has only accelerated. The management and the board are the largest shareholders, which is what we're looking for. In terms of the valuation, we think it's worth $5.50. This is obviously on a 2-year view. The company has got 130 million of cash on the balance sheet. And at this financial result, FY20, they did announce that they will be looking to invest more in their fintech capabilities and solutions by investing in other fintechs and essentially integrating their technology into the EML business in order to accelerate their development cycle. And you can see some of the stuff that they provide on the top right side. So I think, that they couldn't give, obviously with the uncertainty of shopping malls and COVID this year, and Christmas still being a big part of their gift card selling this year. So they're not going to be able to give guidance at the November AGM. So I think this is probably part of the reason where, the share price has sort of struggled since the result. We think once we get through that, and once sort of the world sort of goes back to normal, I think they'll emerge from this. They're probably going to do about 55 to 60 mil of EBITDA this year. But more importantly, we think that they'll bounce back quite hard in FY22. And so in terms of catalysts, obviously that February guidance for this year is important in terms of the gifts, the Christmas gift card sales. Acquisitions, we probably won't see any major ones this year, but we think once things to open up next year, they'll look to acquire things, and any new contract wins that will be announced will be a good catalyst. So a really great business, and one that we're happy to hold on to. So the next one we'll talk about is Redbubble. So $1 billion market cap. This is a global marketplace for independent artists. So they have about 500,000 artists on their website, and essentially you can, as a customer, you can log on and you can choose from many different artist designs, and you can get those printed on demand onto about 120 different product categories. So think t-shirts, face masks, water bottles, hats, and so on. They have a really favorable working capital model. They don't actually hold any stock, so they work with 41 fulfillers around the world, and essentially they print on demand. So if you look on the right, bottom right side of the page, he essentially explains, they sell something for $100. They collect the money within a couple of days, and they only pay out to the artists and the fulfillers a few weeks later. So they have a really favorable working capital model, which funds the growth of the business and is very, very cash generative. The business has listed approximately 6 years ago, and during that time, they've tripled their marketplace revenue dramatically to $360 million in FY20. What we like about this business, it's a global business, so they're mainly focused on North America and Europe. They're not very big in Australia, but this is another COVID winner in terms of online sales. If you look at the top chart here, essentially, the momentum in retail online penetration during COVID has essentially brought fast-forwarded online sale take-up by possibly a decade, and it's currently running at 35% in the US. On top of that, the business has been growing the last 5 years at about 32% per annum. But what's interesting is that at the fourth quarter of FY20, the momentum in the business has really accelerated. They did about $122 million of revenue in the fourth quarter, which if we annualize, we get close to $500 million of annualized revenue. And then in July, the company did $50 million in revenue. So if we annualize that, that's $600 million in sales, and that momentum continued into August. So what's that showing us is an accelerated momentum in their growth rate. Now, in the fourth quarter of last financial year, the business did $10 million of EBITDA, but in the way it books its revenue, it only books revenue when the product is delivered. So there was about $18 million of sales in the fourth quarter, which the cost was borne during that quarter, but the sales will only be booked during FY21. That means that the underlying EBITDA in the fourth quarter was actually $18 million. Now, what's based on our analysis, during July, the company has made about $8 million of EBITDA in July alone. So if we annualize these numbers, we get somewhere between 80 to possibly $120 million of EBITDA for FY21, considering that the first quarter of this financial year is usually only 21% of the year's sales. Now, what all these numbers that I'm throwing at you mean is that we think the market and the analysts are way too low in their forecast for this year. The consensus estimate is about $34 million of EBITDA this year, and we think the business could do anywhere between 80 to 120 mil. It has $70 million of net cash on the balance sheet, and so we think that if our analysis is correct, and when the company will update over the next few months, we think the market and analysts will have to play catch up. Our short-term valuation is $5, but if that scenario which I just painted does come to fruition, then this is a $10 valuation business. It's currently hit $1 billion market cap. It's going to go into the ASX 200. There's a lot of new funds that are now looking at it and buying it. And I think we're going to see them to continue to benefit from this structural change, in terms of online shopping. So in terms of catalyst, first quarter update, which will be in October, is quite important. And then the company are looking to expand, so new product launches, going into new geographies. And then if we just compare them to some of the other online players like Kogan and Temple & Webster, those players are trading on 3.5, 4 times revenue multiples. Redbubble is on 2 times. And then its real global peer, which is a company called Etsy, they are trading on 12 times. So we still think there's huge upside, and this is one of our top holdings in the fund. The next company we'll talk about is Spirit Telecom. So this is a telco, which again, we see them as another COVID-19 beneficiary of, working from home and a remote mobile working force for companies. So Spirit Telecom used to be a bit of a sleepy fixed wireless company on the east coast of Australia. They had a new managing director, Sol Lukatsky, who joined them late last year, and he's really transformed this business into what he refers to as a modern national telco and IT provider. So essentially, instead of just selling their own fixed wireless internet connection to customers, they've essentially launched a digital platform called Spirit X. And on that platform, whether you're a business customer or whether you're one of their national IT dealers or channel partners, you can log onto it and you can put in the address of the business location. And you can, whether you, and then you can connect to a fast internet plan through that platform, whether it belongs to SpiritX fixed wireless infrastructure network, or whether it's an NBN, or whether it's one of their competitors such as Vocus or Opticom or Unity. So they essentially, you know, have now a 80 to 90% coverage. The opportunity is quite big by, you know, by acquiring other companies. They've essentially got a lot more product solutions to offer. So they don't just sell that high-speed data connection. They're now offering cybersecurity, cloud services, PBX, cloud hosting, and other IT services. And essentially, they've increased their market opportunity from $15 billion, which is business telco, to $49 billion, which combines with IT services. So we think that the strategy makes a lot of sense. We like what Sol has done. They are a roll-up in terms of they will keep acquiring companies aggressively in terms of expanding their reach across Australia. But we think the strategy is not just buying companies, it actually makes a lot of sense of what they're buying. And they're creating a really strong IP in that Spirit X platform, which essentially allows them to see where the demand is by getting all these inbound leads from customers. And so that information or that data is quite valuable for all these larger telcos that own huge amounts of fiber networks, because they know where to build, because they know where the demand is. So we think Spirit will eventually become a takeover target as they scale up in the next year or two. We estimate that in FY21, they'll exit the year with at least $85 million of revenue and 15% EBITDA margins. The company has an ambition of becoming an ASX 300 company, and we think that in the next 2-3 years, with the right execution, it's possible that they'll get to $200 million and revenue and $30 million of EBITDA. It's a very tightly held company. The 5 largest holders control about 55% of it. And there is a lot of industry consolidation going on. We've seen, TPG and Vodafone merge. We've seen Unity Group and Opticom merge, and there's other players such as 5GN and so on that are acquiring smaller players. We think Spirit Telecom, is sort of participating in that, and eventually will be acquired. We value this business at 55 cents, but we think that with the right execution on a more sort of 2 to 3 year outlook, this could be a dollar price stock. In terms of the catalyst, the next update will be in October for the first quarter of this year. We think it's going to be an extremely strong quarter. They will do further acquisitions. They recently raised some money, which we participated in, and we think that they're now really well funded to buy further companies this year without sort of tapping the market for any further equity. And eventually, like we said, we'll think there'll be some corporate activity with this company. So one of our top holdings, and we really like this story going forward. Now we're going to the buy now, pay later sector. And, obviously, this is a very hot thematic and a big topic of discussion everywhere around Australia and maybe the world. Our sort of top pick in this sector has been Sezzle. So essentially, Sezzle is one of the top 3 leading buy now, pay later providers in North America. So they're only in the US and Canada at the moment. And they've been growing really strongly. Their growth metrics are probably some of the fastest in the industry. It's a founder-led business. The founders own 50% of the company. They have not sold down yet. And again, this is a COVID winner, so to speak, a perfect storm in terms of structural shifts to e-commerce and online shopping, and the accelerated use of electronic payments and just generally installment payments. You know, we think the younger sort of generation, the Gen Zs of the world, they essentially are not, they're sort of shied away from using credit card. They don't like the way credit cards work in terms of, you know, that bill shock, that unexpected statement that you get the next month. You don't never really know how much your repayments are. And so this new form of credit, this installment payments, allows this new type of consumer, which is the future consumer of the world, to budget in the way they spend. In fact, we actually think that buy now, pay later is a more responsible form of lending. You know, the average transaction is usually around $150 or $200. If you are, you know, you can only be charged a maximum late fee of maybe 40 or 50 bucks. And if you miss on your repayments, you get blocked from doing any further transactions. Whereas with a credit card, you know, you've got this limit of $5,000 or $10,000. And once you use it and not pay it, you know, you get that compounded interest rate on it, which can really drive you into a debt spiral. So we think this is the future. It's going to slowly take over the world, and it's going to be the future of credit, and it's here to stay. And what's interesting is, and really a proof that this is really something that's here to stay, is if we look at that middle table on the right side, it's purchase frequency by cohort. And now this is really interesting because so the customers that are joining Sezzle this year, the 2020 cohort, are currently using the Sezzle product 5 times per year for transactions. The customers that came in 2019 are using it 9 times, and the customers that came in 2018 are using it 15 times a year. If we look at Afterpay, customers of Afterpay who have came in 2017 or before are currently using Afterpay 25 times. So this shows us that existing customers are only using the platform more and more, and therefore we see this as the new norm, and it's here to stay. Now, this is a huge opportunity. In the US alone, there's 84 million Gen Zs. Just to give you an example, Sezzle has got 1.5 million customers in North America. So it's still a huge growth runway to go. You know, in terms of margins, net transaction margins are sort of heading in the right way. In the last quarter for Sezzle, it was 1.7%. QuadPay, which is also a competitor of Sezzle in the US, which is owned by Zip Money, they reported net transaction margins of 2.3%. And so it shows a business that actually long-term is actually a profitable one. And so, you know, why do we like Sezzle? We think that eventually, as more and more players and bigger players like PayPal, for example, has recently entered the market, we think there's going to be consolidation, although the opportunity is massive. And just to give you an idea, buy now, pay later as a percentage of e-commerce payments is currently 8% in Australia, which is probably the most mature market in the world. In the US, it's only 1%. And globally, it's 1.6% penetration. So this is just the beginning of the journey for this industry that's emerging and taking over the world. And we think there's room for everyone. The fact that PayPal has entered this market, just in our opinion, sort of validates what these companies such as Sezzle and Afterpay are doing is the future. And we think that this, you know, in terms of margins and opportunity, there's still a huge runway for growth. Sezzle are looking to potentially expand into India, which is another huge growth opportunity, and potentially maybe in Europe, maybe through acquisitions. They recently raised some money, so they've got about $100 million of cash on their balance sheet. And we think that because they're a pure play into the largest market opportunity there is, which is the North American market, they will probably be one of the first potential takeover targets when the industry eventually consolidates. In terms of a relative valuation, Afterpay is trading at approximately 17 to 20 times revenue, whereas Sezzle is probably on 10 or 12 times. So on a relative valuation basis, we still think that Sezzle is quite attractive. you know, in terms of the valuation, we think the business is worth anywhere between $10 to $12 now. But over the next couple of years, if it continues to grow, we think that multiple gap between them and Afterpay will close, and you know, it could be a $20 stock. We did buy this company at $2 a share, and so we have taken profits along the way, but we still really like the industry, and so we still retain a holding. And I think that if you know, if the sort of perceived threat of PayPal entering the sector creates more share price volatility, and we see the prices fall further, then that could be a really great buying opportunity for the long term. And in terms of catalyst, we think that the next quarter is going to be extremely strong. July transaction volumes were up 14%. That's usually one of the quietest months of the year for retail sales. We think August and September are going to be really good. ASX 200 inclusion is possible at some stage. We think they'll exceed the market forecast for $1 billion of annualized transaction volumes at the end of this year. We think they'll probably do about $1.2 billion at the end of this year annualized. And the really key here is geographic expansion, so possibly into India, which there's actually no one really that's doing this at the moment. And then signing up any landmark larger merchants in the North American market. So good sector, and we think the thematic is here to stay.
Thanks, Ron. I might, before I hop onto my next slide, I know there was one quick question which you've kind of covered off and answered already to an extent, but I might just actually ask you the question and let you go through it quickly. But the question was from John. He was saying, Sezzle's been hit over the last few days. Has that changed your opinion to the sector? I know you've touched on it a bit, but do you want to maybe answer that quickly?
Yeah, look, like I mentioned, I think that if you look at PayPal, you know, they're annualizing close to $1 trillion of transaction volumes. You know, for them, you know, they generate $200 billion of transactions a quarter, $5 billion of free cash a quarter. I mean, you know, the buy now, pay later, them entering the sector doesn't change. In fact, it endorses what companies like Sezzle and Afterpay are doing. And we think that, you know, it's very rare to see an incumbent business enter, you know, a disruptors market and disrupt the disruptors. It's usually the other way around. And we think PayPal, although, you know, they might do okay, we think eventually when buy now, pay later becomes more of a meaningful part of their business, they'll probably end up actually acquiring one of these companies. And so we actually, it doesn't change our view. And in fact, like I said before, if the stock price were to fall further, I think it's a great buying opportunity.
Okay, thanks, Ron. Hopefully you guys can hear me much better now. I've actually just taken the opportunity to change my headset. We'd had some feedback that it was coming through pretty poorly, so hopefully the sound quality is much improved. So just heading through into the next slide, we wanted to just take a bit of time today to talk about the protection that we've put into the portfolio across actually all of our Australian equity portfolios. I think you would be pretty silly if you didn't take the lessons that you learn through bad environments and put them into play in ways that allows you to improve your portfolios or the way that you conduct yourself going forward. So the one thing that we've learned about ourselves going through the COVID sell-off was that while we're exceptionally good at picking the stocks to put into our portfolio and managing the portfolios, what we find really difficult is how to assess external shocks or exogenous events to the actual investment markets and how or when that may come along and actually impact you in your investment journey. So the decision that we've actually made is to have some downside protection included in our Australian equity portfolios on a go-forward basis. So that means going forward, we will always have these downside put options as part of our investment strategy. Essentially what it is, if you look at the diagram on the screen, it's like going out and buying an insurance policy for your portfolio. So you go out, you effectively pay your premium, and below your strike price or the level of the index that you choose, if the index moves below that level, your portfolio starts to be protected from those moves down. What that actually gives you is two things. The first is quite apparent, and that's really just a payment of cash, or you start making money as the markets start selling off. And that's really good, but to our mind, that's only part of the reason for implementing the strategy. The second part, which is actually a lot more important, is that having these put options in your portfolio allows you to actually have the confidence to run your strategy as you normally would. So a really good example would be heading into November, everyone's telling us that the US elections are coming along, and that will create a significant amount of volatility in investment and equity markets. And everyone's panicking and worried about, will that cause markets to sell off? Our view is that is a possibility. It may happen, it may not happen, but we want to be in the position where we can actually go out, buy the shares and the companies that we'd like to invest into in our portfolio, and really remove a lot of that external event risk in the portfolio. So having these downside put options in the portfolio actually allows us to remove a significant amount of that risk. Now, we are quite aware that because we're investing through long put options, which are actually over the ASX 200, so it's an index-driven option, there is a mismatch between those options and the index and the way that our portfolio operates. We're quite happy with that. We understand that mismatch will occur, and certainly if markets sell off, we're of the opinion, and we've seen it happen across the last few years, that everything does tend to sell off very much in the same type of fashion. So happy to have that mismatch, but also happy to have the situation that if markets sell off, we've got the ability to take cash and actually deploy it into the company that we like, probably at the best point in the cycle to do that. So that will be in the portfolios on a go-forward basis. If anyone wants to ask us questions about that or wants a bit more detail around it, we're always available to have a conversation on the phone and discuss how to implement that, or how we've implemented that. Now, just before I hand back to Ron on the Q&A section as well, I just wanted to highlight the Australian All Cap Fund. This portfolio was taken over by Ron at the beginning of 2019, and as you can see, the returns through that year were pretty exceptional, about 55% return through the year. Quite interestingly, it's important to note that the actual index, sorry, I'm just going to mute Ron's speaker as well because we're getting some feedback there. The actual index through that year was about a 23% positive, so significant value add there. 2020 was obviously a significantly more difficult year for markets and for portfolios. But we're proud to show you that portfolio so far for the year is around about 5.8% up. The market through the same period is down 7.3%. Now, you're actually able to invest into the Australian All Cap Fund either through an unlisted unit trust structure or a fund structure, or through our individually managed accounts. The minimum investment there is $100,000. Management fee comes in at about 1.25% with administration and expenses of up to 35 basis points. There is no exit fee on the portfolio, and there's a performance fee of 20% above the hurdle, which is RBA cash plus 2.5%. Applications and redemptions are monthly, and the buy-sell spread is 25 basis points either side. So I might stop talking around the portfolio there and just go to the Q&A section with Ron. We've had quite a number of questions coming through today on the portfolio and questions around our views around markets. So I apologise if we don't get through to everybody's questions. We will certainly send out a list with all the questions and answers to that post today's webinar. So Ron, first question that I actually have for you was around the company that you've talked about a fair bit, Resimac. The question was, we've seen results come out on that recently. Do you have an opinion on those results and the company and the thoughts on it going forward?
Yep. Yeah. In terms of Resimac, yes, Resimac is one of our top holdings. They are one of the largest. They are one of the largest mortgage originators in the country. They had a really stellar result. They grew their loan book to about $12.5 billion in FY20, and they grew profits up 79% to $55 million last year. Now, what's interesting is that unlike the big banks, and the market sort of doesn't seem yet to really understand the Resimac business model yet, but their cost of funding is 100% tied to a fixed margin plus the BBSW bank bill rate of 30 days. And essentially, because of this huge amount of money printing that's been happening, that BBSW 30-day spread has actually gone negative, which means the cost of funding for these businesses come down, unlike the big banks, which rely on deposit funding, and they've been sort of getting squeezed there. Resimac has been benefiting, and so their net interest margin has actually gone up to about 190 points last year. So if we look at the second half of the year, they've actually made $42 million of profit. But what they've done is, this is probably one of the most conservative management teams in the industry. And so they've taken a $16 million of a sort of COVID provision to that profit, which is why they only did $55 million profit last year, instead of really what they did was $70 million. And basically, if you look at sort of all the different sort of economic conditions, unemployment rates, you know, housing prices falls and so on, that the big banks implied over the next 12 months, Resimac has actually taken a really sort of worse outlook than that, and that's where they got that provisioning. So that we think they're pretty well covered, and probably on the conservative side for the next 12 months. So essentially, this is a recurring revenue business. They've got this loan book where it essentially has grown through the year. So they're starting FY21 with a bigger base of loan book, which they're going to clip the ticket on. If we just annualize the second half profit of $42 million, and if we assume that conditions stay the same and the funding costs stay the same, they'll make anywhere between $84 million to $100 million of profit. This is a $500 million company with about 20 mil of net cash on the balance sheet. They've been growing earnings at about 30% per annum for the last 5 years. They're paying a growing dividend. You know, the board owns about 60% of the company. It's very under the radar in terms of the market, in terms of the investor community, and we think that the business is worth over $2 a share, and it will just take a bit of time, but we think that this is a really cheap opportunity, and we own it.
Thanks, Ron. Yeah, look, there's definitely a few more stock questions here. One that I know you've spoken about it a fair bit in the past as well. Bigtin Can, your view on that, and what is the potential upside with that particular holding?
Yeah, so Bigtin Can, quickly, it's a sales enablement software business, a global business, been growing really well over the last few years at 40% per annum. They've had a really strong quarterly update, and they've got about 70 mil of cash on the balance sheet. They've given guidance in the August results that was way above market estimates. So the annual recurring revenue for their software is at about $50 million for FY21, and the market was at about 45. So that was part of the reason that the share price has done really well over the last week or two. We've owned this business since I joined TAMIM, and if you look at SaaS companies globally, you know, up until $50 million of annual recurring revenue, they tend to sort of trade at around 6 times that revenue multiple. But once they sort of bridge that level, it's a very significant milestone, and we think they get a multiple re-rate to about 8 to 10 times ARR multiple. And we think they'll keep doing acquisitions of smaller sales enablement firms that give them more features and capabilities. They were rated one of the highest sales enablement software businesses in the entire world by Gartner Research recently, so that's a real positive. And so we think that when they get this re-rate, they'll enter the ASX 300. We think that the stock is potentially worth $1.80, and so we really like it. And again, it's one of our largest holdings.
Thanks, Ron. I guess a slightly tougher question. I know we like to talk about our winners all the time and the stocks that have gone well, but is there something in your portfolio that potentially hasn't gone as well as you would have liked over the last, I suppose, 12 months or so? And what have you learned from that situation?
Yeah, look, I mean, obviously we've sort of have pivoted the portfolio slightly, obviously after March, to what we thought were companies that are going to benefit. You know, we've had some companies that haven't performed well. For example, Essentia media monitoring business, a turnaround story, which we bought in the sort of 20s, and it's still trading under 20. They're profitable, but have been disrupted by new entrants, and they really haven't been able to sort of plug that hole of revenue leakage. They're still very profitable. The debt's coming down. We're still quite believers that they'll get eventually taken over. I mean, they are the largest media intelligence company in Australia. You know, they make about 100+ mil of revenue and 20 mil of EBITDA. But I think the market is not going to re-rate them until they are able to show that they've stopped the revenue decline. So that's probably one that we got wrong in terms of a turnaround story. Yeah.
Okay. Look, I can see that we're heading pretty close to the hour, so I might just take one more question, and then we'll wrap it up. But the last question that I've got here is: there's obviously been a significant amount of capital raises that we've seen taking place in the marketplace post-COVID. A lot of companies shoring up their balance sheets. Have you been able to take advantage of that? What have you been doing? Have you had a specific strategy around that in the portfolios?
Yeah, so the real benefit of the way we sort of run the portfolios in terms of the IMA structure is that it allows individual investors to actually participate in a lot of these rights issues or share purchase plans that we get through some of our holdings. And so unlike, say, a fund which gets a $30,000 SPP allocation, if it's a $20 million fund, that $30,000 SPP allocation, even if it's at a 50% discount, it doesn't really make much of a difference to the return. But for some of our clients who have anywhere between $100,000 to maybe $500,000 in their portfolios, we've been able to really capitalize on a lot of these SPPs, which were done at a significant discount to the current share market price, and we were able to apply and generate a really strong return for some of these IMA accounts. So that's part of the benefit of having that option of whether it's a fund structure or an IMA structure. And we've been really sort of agile and nimble and capitalizing on these opportunities in terms of SPPs and rights issues.
Fantastic. Thanks, Ron. Look, I might just wrap up the proceedings for today. Ron, thank you very much for taking time out and sharing your views around the portfolio and the number of stocks you hold within it. Just in closing from our side, I think there really are two key catalysts that we see at work in markets today. Number one is a zero, or in some instances, a negative interest rate environment. Our view is that we don't see that changing for the foreseeable future, and certainly that has a dramatic impact on the way people invest and how they search for returns across their investment portfolios. The second key driver that we see out there is obviously the massive government stimulus and the stimulus programs that we're finding not only in Australia but globally, certainly the largest in our lifetimes. That will continue to have a massive impact as well on investment markets, and we think will have a positive impact and will be a driving force for seeing equity markets continue to go up over the next 12, 24 months, maybe even longer than that. So those two key factors will be fundamental catalysts for driving equity markets. From our perspective, we remain invested, we remain positive around what we see as the outlook for the next 12 months. Having said that, we're really happy to have the downside protection across our portfolios, and we believe that gives people the ability to invest into the portfolios and remain calm about those investments. So thank you very much for joining us today. We look forward to receiving any further questions that you may have around our portfolios or holdings inside of our portfolios. And with that, we'll sign out from today's proceedings. Thank you very much.